personal liability for business debts. We already touched on that, but I will just formally confirm that apart from the income tax matters, there is also serious personal liability implications to consider. When running a business as a sole trader, your business and yourself are one body, and technically it means that as a sole trader, you have an unlimited responsibility for business debts. I will be repeating that. If your business is in trouble and is not capable of making loan repayments or pay outstanding bills to your suppliers, the lending institutions or your creditors may sue you for these debts, and the court may order you to repay the debts from your personal assets, like your home, for instance. So this is a serious risk, and it's really very important to consider that. It will depend on the profile of your business, how much risk it carries. It is not applicable to every business. It's really on the individual cases. So I'm just making you aware that this is an important factor which is quite often missed. One other point I would like to mention on this occasion is married couple taxation. This is again a very common mistake. Spouses in a marriage or in a civil relationship make when starting a business. So let's explain what it is about. If you are jointly assessed for taxes with your spouse and one of you is trading as a sole trader, you will have to file a joint income tax return, one income tax return. It's very important that one income tax return is filed for both of you. And what's more important, only the assessable spouse can file these returns, not any of you. And who is the assessable spouse? This is the one nominated by you when you are registering to be jointly assessed for taxes. In the vast majority of cases, this will be the spouse with the higher income. So if you are the assessable spouse and you also trade as a sole trader, it will be yourself submitting the income tax return, and your spouse's income will be included in the joint return. However, in the opposite scenario, when the non-assessable spouse is trading, they will not be able to submit the tax return on their behalf. The other assessable spouse will have to do it even though they are not trading. So let me give you an example. It may seem complicated, but actually it's not that complex. Let me give you an example. There is a husband and there is a wife. A husband is working full-time. He's a manager in a multinational company, and he's on a higher salary, above 40% income tax threshold. And the wife was stay-at-home mom. She was looking after the children, but now she wants to do something on her own, and she wants to start a business. The husband is the assessable spouse because his income is higher, and they chose for him to be the assessable spouse and to file all the returns. But the wife wants to trade on her own. In this case, technically she is able to register as a sole trader, but it is wrong. She shouldn't be doing it because she will not be able to file her tax returns. Only the husband, who is the assessable spouse, should register for income tax, even though he is not trading, his wife is trading. And the assessable spouse, the husband, will be filing the tax return for both of them. And his income from his job as the manager in the corporation will be included, and her wife's income from the small business will be included in this return. I hope this makes sense, but just for you to know that it is actually the most common mistakes I encountered in terms of married couples jointly assessed for taxes. So keep that in mind.